Japan just broke the global financial system. For decades, their bonds were the safest bet on Earth. Now, yields are exploding, trillions are on the move, and what happens next could reshape your retirement, your savings, and the entire world economy. Here's what you need to know. For generations, Japan's government bond market occupied a unique position in the architecture of global finance. It wasn't exciting. It wasn't designed to be. Traders didn't flock to Japanese bonds hoping for thrilling returns or heart-pounding volatility. They went there for one thing: certainty. In a world where markets swing wildly, where currencies crash overnight, and where crises erupt without warning, Japan's bond market was the exception. It was the quiet corner, the reliable anchor, the place where nothing dramatic ever happened. That reputation, built over decades, just collapsed. What we witnessed this week isn't just a shift in numbers on a screen. It's a fundamental rupture in how global capital flows, how nations finance themselves, and how investors assess risk. For the first time since Japan introduced 40-year government bonds back in 2007, yields on these ultra-long-term securities blasted through the 4% mark. And they didn't drift there slowly. They exploded. In a single trading session, yields rocketed to approximately 4.2%, a move so violent by bond market standards that seasoned traders described it as surreal. To understand why this matters, you need to grasp what Japan has represented for the past few decades. This is an economy that has been engineered, structured, and fine-tuned around one core principle: ultra-cheap borrowing costs. Interest rates near zero. Bond yields pinned to the floor. A system where the government could borrow almost limitlessly without worrying about the price tag. That system just received a massive shock, and the aftershocks are rippling across every corner of global finance. Japan isn't just another country managing its own debt. It's the largest foreign holder of United States Treasury securities. That means when Japan's financial conditions change, the entire world feels it. Capital doesn't stay still. It moves. It reacts. And when Japanese bond yields spike like this, investors everywhere are forced to recalculate their strategies. Funding costs rise. Risk premiums increase. Markets that seemed stable suddenly look fragile. In the United States, the immediate effect is upward pressure on borrowing costs. Treasury yields climb. Mortgage rates edge higher. Corporate financing becomes more expensive. Equity markets, which thrive in low-rate environments, start to wobble. Suddenly, safe haven assets like gold look more attractive. And then there's the big one, the elephant in the room that very few people outside of finance talk about: the yen carry trade. For years, this strategy has been one of the invisible pillars holding up global risk assets. Investors borrow yen at rock-bottom rates, convert it into dollars or euros, and deploy that capital into higher-yielding investments around the world. Stocks, bonds, real estate, you name it. As long as Japanese rates stayed near zero, the trade was a moneymaker. But now, with yields surging, that entire foundation is cracking. If the carry trade starts to unwind, trillions of dollars in leveraged positions could be at risk. That's not a minor footnote. That's a potential earthquake. What was once the most boring, predictable, and stable bond market on the planet has suddenly become a flashpoint for global uncertainty. And at the heart of this chaos? Politics. Earlier this week, Japan's Prime Minister Shigeru Ishiba dropped a bombshell. He announced snap parliamentary elections set for February 8th. On the surface, it seemed like a routine political maneuver, but the language he used sent a clear signal to anyone paying attention. He framed the election as a referendum on, quote, major policy changes. Investors didn't need a translator. They knew exactly what that meant: bigger government spending, aggressive fiscal stimulus, and a willingness to abandon budget discipline. This wasn't a surprise out of nowhere. The warning signs had been building for months. Back in November, the Japanese government unveiled a colossal spending package worth $135 billion, aimed at boosting economic growth and supporting households. That alone raised eyebrows. But then came the real kicker: a proposal to suspend Japan's 8% sales tax on food for 2 full years. On paper, it sounds compassionate. Families are struggling with rising costs. Food prices are climbing. A tax break offers immediate relief. But from a fiscal perspective, it's a nightmare. Suspending that tax means losing billions in government revenue at a time when the country is already drowning in debt. And Japan's debt problem isn't new. It's been festering for decades. Right now, Japan's government debt stands somewhere between 200% and 250% of GDP, depending on how you calculate it. That's one of the highest debt loads in the entire world. For years, this was manageable, but only because of one factor: interest rates were effectively zero. When you can borrow for free, debt servicing isn't a crisis, it's just accounting. But the moment rates start climbing, even a little bit, the math changes fast. Higher yields mean higher interest payments. Higher interest payments mean bigger deficits. Bigger deficits mean growing doubts about whether the government can actually sustain this. And that's exactly what markets are starting to price in. Bond traders didn't wait around to see how this plays out. They moved immediately. Investors dumped ultra-long-dated Japanese government bonds in waves, driving prices down and forcing yields sharply higher across the entire curve. The 40-year bonds bore the brunt of the sell-off, but the carnage spread. 30-year bonds, 20-year bonds, all of them got hit. In just a few weeks, yields on 40-year Japanese government bonds climbed from roughly 3.6% at the start of the year to over 4%. That might not sound dramatic to the average person, but in bond markets, it's seismic. These ultra-long-term bonds aren't controlled by central bank policy in the same way short-term rates are. They reflect something deeper: investor confidence in a country's long-term fiscal health, political stability, and ability to manage its debt without resorting to desperate measures. Short-term bonds respond to interest rate expectations. Long-term bonds respond to trust. And right now, trust in Japan's fiscal future is eroding fast. One bond trader, speaking to the financial press, described the sell-off as, quote, "an extreme event, well beyond normal historical ranges." That's not the language of calm adjustment. That's the language of panic. Investors aren't repositioning gradually, they're fleeing. This raises a question that Japan can't ignore. Who's going to buy all this debt going forward, and how much will it cost? For decades, Japan had a built-in advantage. It could rely on a deep pool of domestic buyers. Pension funds, life insurance companies, conservative institutional investors, they all lined up to purchase Japanese government bonds. They didn't need high returns. They needed stability and predictability, and Japan delivered that consistently. But that era is ending. Japan's population is aging at one of the fastest rates in the world. Savings patterns are shifting. Institutional balance sheets are stretched. And global investors? They're demanding higher yields to compensate for the risk. The old model, where Japan could always count on someone to absorb its debt at low cost, is breaking down. The cracks are already visible. At the most recent auction for 20-year Japanese government bonds, demand came in weaker than expected. The bid-to-cover ratio, a key measure of auction strength, fell below recent averages. That's a red flag. It shows that investors are stepping back, not stepping in. They're no longer willing to buy long-term Japanese debt without demanding a higher price. And because Japan is so deeply integrated into global capital markets, these tremors don't stay contained. They spread. Rising Japanese yields are already starting to reshape global asset allocation. They're altering funding conditions. They're introducing volatility into markets that had grown comfortable with stability. What was once the safest, most predictable bond market in the world is now emerging as a major source of global financial risk. For decades, Japan's near-zero interest rate environment turned the yen into the world's cheapest funding currency. Investors borrowed yen for almost nothing and funneled that capital into higher return assets overseas. U.S. Treasuries, European stocks, emerging market bonds, corporate debt, real estate, you name it, the yen carry trade helped fund it. This strategy quietly became one of the most important sources of liquidity in global finance. It worked seamlessly as long as Japanese yields stayed near zero. But now, as domestic interest rates climb, the entire logic of the trade is breaking down. When Japanese 40-year bonds start yielding close to 4%, the math changes overnight. Why take on currency risk, leverage, and foreign exposure when you can earn a competitive return at home with far less risk? Japanese investors are looking at their options and realizing bringing money back home suddenly makes a lot more sense. And when capital starts flowing back into Japan, global markets feel the impact immediately. We saw this play out in real time. On the same day that Japan's 40-year bond yield crossed the 4% threshold, U.S. 30-year Treasury yields surged to around 4.9%, hitting their highest levels in months. That's not a coincidence. Long-term borrowing costs are rising globally, not because economies are booming, but because one of the world's biggest capital exporters is pulling back. As Japanese money becomes less available to foreign markets, yields everywhere are getting pushed higher. And if this trend continues, the consequences will be severe. For Japan itself, rising yields mean ballooning debt servicing costs. With one of the largest public debt burdens in the world, even modest increases in interest rates can blow a hole in the national budget. Over time, that limits fiscal flexibility and raises uncomfortable questions about sustainability. The Bank of Japan is now trapped. If it intervenes aggressively to cap yields and prevent them from rising further, it risks destabilizing the yen and sparking a currency crisis. But if it steps back and lets yields climb freely, market volatility could spiral out of control, both at home and abroad. There's no easy way out. Every option comes with serious trade-offs. The global implications are profound. Higher long-term interest rates act like gravity on risk assets. They pull capital away from stocks and into bonds. They tighten financial conditions. They threaten to unwind years of leverage that was built on one critical assumption, that Japanese interest rates would stay near zero forever. That assumption is now in serious doubt, and its collapse could trigger a cascade of selling across global markets. This is why investors worldwide are now laser-focused on Japan, not because of strong economic growth, not because of inflation surprises, but because of political uncertainty and growing alarm over the government's fiscal direction. Japan still has the ability to spend. What it's lost is the luxury of pretending that borrowing comes without consequences. The era of free money is over. Markets are waking up to that reality. What happens between now and the February 8th election could be decisive. The policy choices made in the coming weeks may determine Japan's long-term fiscal path and influence the trajectory of global bond yields for months, possibly years to come. In a world already strained by record debt levels, tighter financial conditions, and fragile investor confidence, Japan's bond market is no longer a quiet corner of finance. It's a live risk factor, and it's one that no serious investor, no matter where they are, can afford to ignore. The calm has ended, the storm is here, and the world is watching.